Hello everyone, happy Friday. My name is Ben Decker and I'm going to go over some 0 days to expiration SPX Iron Condor trade that I like to do. Hopefully this video goes better than the last one. My internet isn't the best, so hopefully it goes alright. So, market just opened. So I'm going to go through this on tastyworks. So from the grid page, here's SPX. We'll utilize that. And then also under trade and under grid, I have 2 columns, 1 row here. And I have the ES futures on one side and the volatility futures on the other side, so I can watch those as well. If you're doing this, you can click on the arrows and these graphs will come off, so you can have them off on a different screen or size them however you want. So the reason I watch ES and VX is VS gives you volume, SPX doesn't, and I want to make sure that these are inversely correlated. So if ES is going up, I want to see VX going down. And you can see that here. We're down 12 points in the E-minis, and we're up 45 cents or ticks in the VX. So that relationship is good. If both were down or both were up, then the direction of the market might change. And so that's what I look at. You can also look at different indicators and such to figure out the direction. I don't do that. So positions, before we get into it, I did a Suber's earnings trade. Looks like it's going to be a winner. So I'm just going to close that because I don't want to have Uber for too long. So I had the 39.30 strangle, short strangle, and Uber didn't move much, so that'll be a winner. So I'm just gonna get out of this before we get started here. And alright. So this trade I learned from Tammy in the trading options, tastytrade options Facebook group. I pretty much follow her rules. She did a more in-depth video and has a good write-up in the file section. So I'd recommend going through that. This video I want to do more high-level, kind of for newer traders. This isn't a trade recommendation. Do your own research beforehand. I'm not responsible for anything you do, so you can follow me if you want, but do your own research. Alright, so we're going to go SPX here. I guess first I'll start with, so 0 DTE, 0 days expiration, happens every Monday, Wednesday, Friday. So today's Friday, so August 7th is the expiration I'm going to go in. Here's option chain. One thing that a lot of newbie traders don't quite understand is the delta. So the delta is shown on a per share basis. So this delta here is 0.5, but option traders will call this the 50 delta. So if you times this by 100, which is the number of shares that an option contract holds, it would be 50. So with this Iron Condor trade, we want to go somewhere between the 5 and 10 delta, so the 0.05 and the 0.1. So on the call side, we'd be looking at somewhere between 33.65 and 33.75. And on the put side, we'd be looking at 3,300 down to 32.85. So that's kind of the range you want to put these on, and that's the short leg of the Iron Condor. With the five delta, you're not going to get paid as much, but you're also going to have less stop outs. 10 delta, you pay a little bit more, have more stop outs. Over the long term, they're pretty close in returns. I know Tammy likes to do the 5 delta. I like to be a little bit more aggressive and go with the 10 delta. So that's all personal preference. So if you're starting out, maybe start with the 5 delta. You're not going to get paid as much, but you won't get stopped out as much. And I'll go through that a little bit. So I'm just going to look at the chart here. I usually like to put this on somewhere in the first 15 minutes of trading. Especially in this market, it seems like the market goes up or down in the first half hour maybe, and then it flatlines. It's not really what we're seeing today or at the open, but if we go back in time, I guess Thursday wasn't really a good case either. So Thursday kind of stayed flat, and then it went up. If we look at Wednesday, so Wednesday it jumped up, and then it pretty much stayed in the range all day. So Wednesday was a perfect day for 0 DTE. Hopefully today is another day similar like that, so it's just flat. So this trade we don't want SPX to move very much. So you can also go in here, go to the grid. So like we saw before, ES is down, BX is up. That's good. So I'm okay with putting this trade on. I looked at the calendar. There was a jobs report this morning. Nothing really today though, so nothing should affect the market too much, hopefully. So let's get started here. So SPX. If you're a more intermediate or advanced trader or have been doing this a bit, you can leg into the Iron Condor or just do one side. So Iron Condor, you're doing both sides. So you're doing a short put spread and a short call spread. And you want the market to stay in between. If the market is directional, if you think it's going to go up or if you think it's going to go down, you can just do one side. And that's called a vertical spread. So if you're a more intermediate or advanced trader, you can leg into the Iron Condor and do both sides as two separate orders. If you're going to do that, you can watch the market. So if you think the market's going to go down, you would do a short call spread. So when I would enter that would be on a uptick in SPX. So if I was going to do a call spread, I would wait until these candles might start going down, but then we might have a larger green candle. When that candle goes up, that's where I'll look to enter. And the reason you look to enter on a uptick would be the premium's going to go up a little bit on the call side. So vice versa on the put side. If you think the market's going to go up and the candles are showing an uptrend, and then there's a larger red candle, I'll look to put on the put spread at that point. If you're a newbie trader, that's what I'll do today. You can just enter the Iron Condor as one trade. So going back to SPX, like I said, we want between 5 and 10 delta. So on the call side, we got a 9 and a 6. The 9 doesn't have very much volume, but it's 15 to 10 cent wide, and you're going to find that on all the strikes. So I'm actually going to start on the put side, I think. Doesn't really matter. So the 8 delta has 1,000 and the 6 delta has 1.2 thousand. So both have good volume. So nice round number, 3,300. I'll start with that. So I'll do that on the put side. On the call side, I'll go with this one. Why not? So, like I said, I'd like to be a little bit more aggressive. If you're starting out, maybe start with the 6 delta. In here, you could go down to the 5 if you want. So I got my short strikes picked out. You can see the buying power. I would need 81,000 bucks to put this on for $1.85 in credit. So the nice thing with Iron Condor is you add wings to reduce your buying power. So doing some, or what Cami has found is if you go $50 wide, that's a good way to go. So on the put side, I'm going to go down 50 points. You can see the long is the 10-20 bid ask. Ideally, you want to pay as little as possible. And the wider you go, the greater your decay is going to be throughout the day, or the faster this is going to come in. So if you wanted to take this off at lunchtime, a wider spread would be better. So on the call side, here's 65. So we want 15 in here. So here's a scenario where it's the 5-10 bid ask. So I go to the 34.15 and pay 5 or 10 cents, or I could go up 2 or 10 points and pay the same thing. So this is a scenario where I'm going to go 50 points on the put side, but only 40 points on the call side, and have the same, pay the same amount. So I'm going to do that. And you can see the buying power came down to 48.45. So if I was doing this in my account, I would want to be sure that I have at least $10,000 to $20,000 in net lick to do this. When I go through the stop loss here in a bit, you'll see that our max loss will be about 2 times the credit. So if we take in $1, let's call it $1.40, probably by the time $1.35 maybe by the time we put it in. If it's $1.40, then 280 bucks is going to be our max loss, or that's what we want to set it at. But if something went horribly, terribly wrong, you could be looking at closer to a $5,000 loss. So if you're trading with like a $5,000 account, you want to be more careful, because if something goes terribly wrong, your account is going to be blown up and then you won't be able to recover. So that's just the risk tolerance, or the risk management part of this trade. And risk management is the most important part of trading. It's really easy to blow up your account, so you want to make sure you're doing everything you can to protect your account value. So I've talked a little bit, just to review here. I'm at the 8 delta for the short side on the puts, and the 9 delta on the call side. Go back to the chart. So you can see we've upticked a little bit. We're still pretty close to the 33.40. You know, if I was putting this trade on without the video, maybe I wait. Maybe I think it's going to stay range around here. But if you think maybe S&P is going to go up to 33.45 or 33.50 and then flatline, maybe you wait. So somewhere, I'm in the central time zone, so I like to put this on somewhere between 8:30 and 9, depending on the market. So this is a pretty large candle here, and I do the 2-minute candle. You can do whatever preference you want. It's going to show pretty much the same thing. So 1-minute candle, you know, looking here. You can also use the grid. I'm on my laptop, so you can't do quite as many grids. I think you can do 3x2 if you have a big computer monitor. I could go up to 3 if I wanted, so I can put SPX here if I wanted, or something like that. But SPX and BS are going to show pretty much the same thing. So I just do 2. And normally I have these separate windows, but since I'm doing this video, I can't do that. So, whoops, go back to the grid. So you can see with that up move, my delta changed from the 9 delta, now it's an 11 delta. This should go down, yeah, it was an 8, now it's a 6. So, with the 0 days to expiration trade, right away in the morning, the strikes are going to move quite a bit, because there's more time for the market to go against you. As you get later into the day, these type of moves aren't going to affect you as much as long as they're in the middle or away from your spreads. So I'm just going to go ahead and put this on. I think so I'm at the 10 delta here, I'm at the 6 delta there. I'm going to move the puts up, and like I said earlier, I just like to be a little bit more aggressive. You can go down to 32.95 if you're starting out. So $1.60, I don't think I'll get filled there. I'll put it on. I usually wait 20 seconds or so, and if I don't get filled, I'll replace it. So I'm just going to go a little bit faster here, see if I can fill it. So $1.55, so that's my max. That's my max gain on this trade throughout the day. So here's the most important part of this trade, and that's setting the stop loss. So this is where in the long run, over a long period of time, you'll make money if you use stop losses. If you just let this expire, I think you'll still make money, but your drawdowns are going to be a lot bigger. And like I said earlier, risk management is really important, so we want to mitigate that. So the way that we set up stop losses is we want to set it up so that our max loss is 2 times the initial credit. And we're only going to set it on the short strikes. So you can set it on the spreads if you want. Don't recommend it. Recommend just doing it on the short strikes. So, and it's going to be based on the credit received. So 92 cents here is what we got on the put. So actually I should have had my calculator up so I could show this to you guys. Pretty basic. So 92 cents is what we took in. If we want our max loss to be 2 times that, that means we need to set the stop loss to 3 times this credit. So hopefully that makes sense to you guys. It can be a little confusing for newbie traders, but since you took in that credit, let's say if this got up to 180 and you paid 180 to buy it back, that would be a net loss of 90 cents because you already paid or took in 90 cents for that option. So 92 cents times 3 is going to be 276. So you can go to 275 or 280. I'll go to 280. Whoops. So 280 here. So I'm going to right click. I'm just going to highlight the put. Right click, close position. And we want to set a stop limit. Stop markets you can do, but you can't control it as much, especially in the last 15 minutes of the day. So I'd recommend always doing a stop limit. If you don't know what a stop limit is, I did another video that describes it. So I'm going to click stop limit, and our stop price is going to be this guy. So I'm going to go 280. So once, the way that tastyworks does it is if the bid or the last trade is 280, it'll trigger the stop limit. And it'll trigger it with a limit order of whatever you set here. So what Tammy's found is you want somewhere between 30 and 50 cents above your stop limit. So I usually go 40. So I go to 320. So this would trigger if the bid or the last trade of this 33.05 put strike here, if it's 280 or above, it will trigger my stop limit, and my limit price will be 320. So I won't pay any more than 320. So if the market completely tanks and these things are going crazy, I might not get filled here. But that's why we have a 40-cent difference. If you want to be more conservative, go up to 330 or 340. I like to do 40 cents. I haven't been doing this too long, but it's worked for me. So I'm going to do 320. And just so if we did a stop market, I'll just show that too. So you'd put 280 in here. Once this hits 280, or the last trade hits 280 or above, then this will trigger, and it's going to get you out immediately at whatever the market price. So if there's a bad fill, let's say at the last 5 minutes of the day, and this just happened recently where some strike was way out of the money, and someone bought or sold at bought at $5. Well, if you had a market here at 280, the market price would be $5. So even though this is far out of the money with 5 minutes to go and you're completely fine, the last trade was $5. That's the market. This would get out at $5, so that would be a big loss. But if you had a stop limit here and had 320, if it's trying to fill at $5, that's above 320, so it's not going to get filled. So you'll be protected there. Whenever possible, the last 10 minutes, I like to take off my stops if my strikes are way out of the money. So that way I don't even have to worry about the bad marks here. So, alright, enough about that. I'm going to put that in. So here, if we hit 280, this will trigger the loss here, stop loss. So now we're going to do the call side. Call side is 87. So 87 times 3, 261. So you can go 260, I'll go 265. I like to round up. Oops. So I'm going to highlight the call here, right click, close position, order type stop limit, and our stop price is going to be this number here. So I got 265. The reason you can't go to 261 is SPX options trades in nickel intervals, so it won't work. So 40 cents above that is 305, and it doesn't matter if this is day, good till canceled, or good till date. Since this is a 0 days expiration, it's going to be the end of the day anyways. So send order. Price must be in increments of 0.1 for this order. I don't know why that's a new. That's something new. I don't know why. It's weird, I've never got that error message before. So I'll go 310. Huh. Don't know why that is. If you guys know why, maybe comment on the video. Never seen it happen before. Alright, so we got our trade in, got our stop losses, so we're set. So really no management in this. You can monitor it. You can set alerts if you want. With tastyworks, the only alerts you can do are based on the actual stock price. If you're in Thinkorswim, you have a lot more options. You can set alerts on, the bid or the ask on an individual strike. So that could be a little bit more useful. So that's the 0 days to expiration SPX Iron Condor trade. I like to do this every Monday, Wednesday, Friday. It's been pretty successful. Good way of taking in consistent income, in my opinion. So, like I said, do your own research. If you're just starting out, I'm just going to quickly point out SPX, SPY. We track the S&P 500. Well, SPX is actually the S&P 500. SPY is the ETF for it. But if you're just going to start, you could do it in SPY if you want it. It's a smaller product. The disadvantage, there's a couple for the SPX. It's a cash settled index. So let's say you didn't have stops, and let's say SPX went to 3,300. This put strike would be $5 in the money, so you'd be out $500. In a typical stock, you would be assigned shares at that point, but SPX is cash settled, so it'll just take $500 out of your account, and that'll be it. So if you're trading this on a 0 days expiration, the brokerage isn't going to close your account or close your position. Sorry. If you're trading SPY, and let's say you did something like this at the beginning of the day, and this expired. This is 25 cents in the money. That's $25. Or if you didn't have the funds to take 100 shares of SPY, the brokerage is going to close out this position within the last hour of the day. And even if it's close, if it's, even if you have something like this in the last hour of the day, they might think that this is risky. Where if the stock lands in between your short and your long, you would get assigned 100 shares on your short, and your buy or your long wouldn't protect you. So for the brokerage to reduce their risk, they're going to close out your position the last hour of the day. So that's one disadvantage with using SPY, but it's a lot smaller, so it's another way to do it. If I was doing it in SPY, I would do a $5 wide. It'd be the same as a $50 wide in SPX. So just to set it up quickly here, now I would do something like this. Here's the $5 wide, but there's no bid, so I'd go up. So it's only a $2 wide on the call side. So I'd do something like this. Max risk of 487. You only taking 13 cents, and after fees, it's going to be $8. So not really worth it in my opinion. But if you just want to get your feet wet, you could do this. Stops are the same, 3 times your credit. So I think that's all I'm going to talk about in this video. You can see it's marking a loss right now. That's pretty typical for the beginning of the day. These moves are going to affect the option pricing more in the beginning of the day compared to the end of the day. So this is kind of an example of what I was talking before. The market is, or it appears that the market's trending up. You could have different indicators that might tell you otherwise. I don't use that, so maybe if you waited to do this now, maybe you just put on the put side, and you wait till a bigger red candle. So like here might have been a good spot to put in your short put spread if you were bullish on today. So if you're just getting started, I think this is a good high-level video. Like I said, Tammy's done another video that's more in depth with PDF write-up, so I recommend that. If you have questions, leave comments. You can message me on Facebook if you want. I'd be happy to answer any questions you have or do any clarification videos. So hopefully this was helpful. If you liked it, maybe give it a thumbs up, hit the subscribe. I'll try to do this on a frequent basis. I had off today, so I figured I might as well do a live video here. Depending on how this goes, maybe I'll do a video at the end of the day too. we'll see. But thanks for watching, and hope you enjoyed it.